Hello, welcome to Managerial Accounting, Principles of Managerial Accounting. The very first thing I want to talk about is the difference between a product cost and a period cost. A product cost follows the product. So it's going to end up going into the work in process inventory account. So work in process is an inventory account which shows up on the balance sheet. It's a current asset with a normal debit balance. You will increase it with the debit and decrease it with the credit. And that's going to be important in Chapter 2 when you start making some journal entries. There are three items that go into the work in process account. The first one is direct materials, the second is direct labor, and the third is overhead. So when you see the work in process T account, you can know that you've got all the journal entries made when you have direct material, direct labor, and overhead included as the debits to the work in process account. Okay, as a review, there are three inventory accounts typically for manufacturing accounting. You have an inventory account for raw materials, which will include both direct and indirect materials. You will have an inventory account for work in process. Some books call it work in progress, same difference. And the last one is your finished goods. And it kind of follows the flow of the materials through the manufacturing facility. You purchase the raw materials, you put them into work in process, you add direct labor and overhead. When the product is finished, it goes out of work in process and comes into finished goods. Then when you sell it, it comes out of finished goods and goes into cost of goods sold. So it just kind of follows the product through the system. Okay, so product cost will go to the income statement first, the balance sheet first, and then when they're sold, they're going to go to the income statement. A period cost, on the other hand, will never ever show up on the balance sheet. It goes straight to the income statement as part of the operating expenses for selling or administrative expenses. So a selling expense would be like a salesman's commission. Administrative expense would be the president's salary or vice president's salary. Okay, both of these go on the income statement. They're both classified as operating expenses. They both have normal debit balances, increased with the debit and decreased with the credit. Okay, so that kind of takes care of just the basics for product and period cost. The next thing that I want to cover is the fixed and the variable cost and how they behave. This little chart I've used for years and years and years, and it's served me well over time. What you want to consider when you're trying to figure out if a cost is fixed or variable is how it behaves per unit and how it behaves in total. So a fixed cost is going to stay the same in total, which means that it will vary per unit. Whereas a variable cost stays the same on a per unit basis, but it will change or vary in total. And then there's another type of cost called a mixed cost, which is usually it's the sum of a fixed cost and a variable cost component, so that the total cost changes in total based on how many units, and the per unit changes based on how many units for the fixed cost component. So it doesn't behave exactly like a fixed or exactly like a variable. So what we try to do then is we try to separate the mixed cost into the fixed cost and the variable cost component. There are three methods typically that are used: a scatter graph, a regression analysis, and high-low method. The only one I'm going to show here is the high-low method, probably because it's the easiest of the three. Well, the scatter graph might be the easiest, but it's not reliable at all. So the high-low method at least has some reliability to it. So the purpose of the high-low method is to separate the mixed cost into their fixed and variable components. All right, so I'm going to assume that we have the following expenses. We have rent, depreciation, supplies, and utilities. All right, rent is $200,000 if we produce 50,000 units. It's also $200,000 if we produce 100,000 units. So that tells me that it stays the same in total, but it changes per unit. Okay, so if I take the 200,000 divide by 50,000 units, I get 25 cents. If I take 200,000 and divide it by 100,000 units, per unit. Cost per unit. I take the 200 and divide by 100. So 200 divided by 100,000 is $2. And 50,000 per unit, cost per unit. Okay, equals. Let's try again. I got it wrong. Sorry, guys. I'm going to take my cost and I'm going to divide by 50,000 units. Okay, so I got a $4 per unit or a $2 per unit. Okay, so the depreciation, I do the same. It's 40,000 if you make 50,000 units. It's 40,000 if you make 100,000 units. So, okay, so I need to take this formula and bring it down all the way. Take this one and bring it down. Okay, that's better. All right, depreciation, 40,000 total dollars. If it's 50,000 units, $40,000. If it's 100,000 units, stays the same in total, so it's a fixed cost. So if I take the 40,000 divided by 50,000 units, that's going to give me 80 cents per unit. And if I take $40,000 and divide it by 100,000 units, that's going to give me 40 cents per unit. So you notice that it is not a true variable because it stayed the same. Let's try again. It is a true fixed because it changed on a per unit basis based on the number of units. All right, supplies are $75,000 if we make 50,000 units, or, okay, 75,000 divided by 50 gives me $1.50 per unit. If it's 100,000 units, we spend 150,000 units, so the costs are different in total, so they're different in total. And when I run the numbers, 150 divided by 100,000 gives me $1.50. So here the supplies are the same on a per unit basis, so they meet the definition of a true variable cost. All right, a mixed cost for utilities is 80,000 if you produce 50,000 units, and it's 130 if you produce 100,000. So that gives me the definition. They're not the same in total, so it changes, which looks like a variable cost. So let's see if the per unit amount is the same. If I take 80,000 and divide it by 50,000 units, I get $1.60 per unit. If I take 130,000 and divide it by 100,000 units, I get $1.30 per unit. So it's changed on a per unit basis, which makes it look more like a fixed cost. So that tells me, because it has a fixed cost and a variable cost component, it is probably a mixed cost. So what we're going to do is we're going to break down that mixed cost into its fixed and variable components by using the high-low method. So I'm going to take my dollars divided by units to get a cost per unit. So I'm going to choose the high level and a low level. I just happen to have the 50 and the 100,000 there. So my dollars at the high level for utilities is 130. My my units for the high level is 100,000. At the low level, my dollars are the 80,000 and my units are the 50,000. The difference is 50,000 units divided by 50,000. Let's try again. $50,000 divided by 50,000 units gives me $1 variable cost per unit. Okay, so now we put it in a formula that we know. Fixed cost plus variable cost equals total cost. So you can either work it at the high level or you can work it at the low level. You don't have to do both. But because I'm a little bit anal, I'm going to do both just to prove that I'm right. So the fixed cost, I'm going to draw a box around it because I have to find that number. So don't even pay attention to that 30,000 right now. I'm going to take the variable cost. So at the high level, it's the $1 per variable cost per unit times my 100,000 units at the high level gives me $100,000. My total cost at the high level is the 130 for utilities. So 130 minus 100 gives me 30. Okay, so let's try it at the low level and see if it still comes up with 30,000. So I draw a box. I don't know what it is yet. I compute my variable cost at the low level, $1 of variable cost per unit times the 50,000 units gives me $50,000. My total cost of utilities at the low level is $80,000. 80 minus 50 gives me 30. Okay, well, we found that out. Now what do we do with it? All right, the cost formula, be helpful if I could spell. Okay, cost formula is y equals a plus bx. So the y is the total cost, the a is the fixed cost, the b is the variable cost, and the x is the number of units. So what we can do with this is we can play what if, and we can figure out what the total cost is for utilities at any production level we want to within the relevant range. So we know, we just figured out that the fixed cost is 30,000. We can add the variable cost, $1 per unit times 75,000 units, 75,000. So our total cost we can anticipate for utilities at a 75,000 unit production level would be 105,000. And that's going to be helpful when you get into the chapter on budgeting and you're trying to plan for the future to see how much it's going to cost you to produce so many units of product. All right, that's it for this one. Good luck with it.